Over the first half of 2022, the S&P 500 was down close to 20%, which is the worst start of the year for the market since 1970. Because of this, we have many quality dividend-paying companies trading at lower prices with higher dividend yields. In this video, I'm going to be discussing 5 dividend stocks that I have been buying during the recent market downturn. These are all companies that I believe at some point over the past few months have been trading at a good value and have shown that they're committed to consistently increasing their dividend payouts over time. The end goal of my dividend portfolio is to have the ability to live off of dividend income, and I believe that each of these companies will help me reach that goal. The first company that we are going to be looking at is within the financial sector, and that is JP Morgan. JP Morgan is down nearly 30% year to date, which gives the company a dividend yield of almost 3.5%, which is quite a bit higher than most bank stocks will typically pay. With inflation running hot, people are concerned about the continuous interest rate hikes from the Fed, but as it turns out, banks typically do pretty well in a rising interest rate environment. Banks lend money at higher rates than they borrow, pocketing the difference. When interest rates increase, the spread for how much a bank can earn continues to widen. But let's go ahead and jump into my stock valuation spreadsheet. If you'd like to be able to download any of the spreadsheet used in this video, then you can head over to my Patreon page at the link in the description. But we're currently looking at JP Morgan. Because they do have a higher dividend yield, we do want to take a glance at the payout ratio, but we can see at just 31%, this is a very safe dividend paying stock. Analysts currently have a target price of right at $139 to $140 per share, and they're down from a 52-week high of $172. But let's go ahead and look at a few valuation models, and the first we'll look at is Graham's valuation. We'll go ahead and zoom in a little bit. This is a valuation model invented by Benjamin Graham. And here's a formula he laid out for us to calculate intrinsic value. After plugging all these variables in, we can see we come to an intrinsic value of $126 a share, which is a little bit higher than the current price. Now, looking at the discounted cash flow model, this actually isn't always the best way to value a stock that is within the banking industry. So typically what you look at instead is assets under management. And for assets under management, JP Morgan is actually the largest bank in the US, so that is a huge plus for JP Morgan. But let's go ahead and glance at our multiples valuation. And essentially what we're doing is we're just taking companies that are similar to JP Morgan, looking at their stock price and dividing by the earnings per share to get their price to earnings multiple. We then take the average price to earnings multiple and multiply it by the earnings per share to find the intrinsic value. And according to the multiples valuation, JP Morgan is right at 130. Now, looking at our last valuation model, which is the dividend discount model, this is typically one of the most important valuations that a lot of dividend investors will want to look at because it takes into account how much a company pays out in dividends and how much that dividend is increasing, which for me, looking to live off of dividend income, you can see why this is such an important valuation. But essentially what we're doing is we're plugging in the quarterly dividend payouts right here so we can see how much the company pays out yearly. And this allows me to see the year-over-year growth rates for their dividend payouts. And we can see they've had an extremely high average growth rate over the past few years. So moving forward, I am projecting a growth rate of 6% for their dividends, quite a bit lower than their average growth rate over the past few years, but 6% is still a relatively high dividend growth rate, especially for a bank stock. After applying a discount rate of 8.5%, you can see I came to a price per share using the dividend discount model of $169. Jumping into our output tab, we can see all three of these averaged together. We come to an intrinsic value of $142 per share. Now, if we apply a 20% margin of safety, we can see our acceptable buy price is right at $113 per share, which is very close to the current trading price. A lot of the times I do seek to apply a 30% margin of safety since I am a more conservative dividend investor, but I think with as much dividend growth as we're seeing and the really high starting dividend yield from a company in the banking sector, this does make this a more attractive investment. But let's go ahead and move on to our next company. Microsoft Corporation is currently down about 15.5% year to date. We can see they were trading as high as $350 per share over the past year, but it took a huge dive down all the way to $241 per share. Over the past month, it's made a pretty nice recovery. They were as low as about $250 per share, now trading at $282 per share. But let's go ahead and jump into our valuation spreadsheet. If we come up in here, we will plug in the stock ticker and hit enter, and we can see all of this data will load in. Dividend yield currently pretty low at right at 0.88%, and a nice safe payout ratio at just 25%. We're currently looking at a 700-day chart, but let's go ahead and zoom in a little bit more and look at a 1-year chart. And here's where we can see a huge decline in the share price. Now, obviously, trading within information technology, analysts currently have a target price of $335 per share. Now, something I love about this company is how strong their discounted cash flow model valuation is. Let's go ahead and zoom in. And you can see I'm applying a growth rate projection of 17% to the future free cash flows of the company. added the company's cash and cash equivalents, subtracted out their total debt to get the equity value, and divided by the shares outstanding, and this led to a discounted cash flow price per share of almost $360 per share. Now, I applied Graham's valuation, multiples valuation, but let's go ahead and look at the dividend discount model since we are obviously dividend investors. Now, really strong year-over-year dividend growth from this company, average of right at 10.23%. I'm applying a growth rate of about 8.25%, which is really strong, and a discount rate of 9%, which leads to a dividend discount model of right at $358 per share. Now, anytime a company has a really high dividend growth rate, again, we'll jump back over to our stock screener, look at that payout ratio, but we can see this is a very safe dividend paying company. Jump over to our output tab and we can see all 4 of our valuation models. Graham's at 280, multiples at 268, discounted cash flow at 358, and dividend discount model at 358 as well. Now, the multiples valuation I feel like is not actually providing the most fair valuation in this circumstance due to the fact we're seeing a lot of companies trading at lower price to earnings multiples due to the recent market decline, such as Meta. So I don't think this is providing as much of a fair valuation. So I'm actually going to remove that one, and we can see using these 3 valuations, we come to an intrinsic value of $332. Now, the current price is $282, and once again, if I apply a 20% margin of safety, you can see it's actually still not quite our acceptable buy price. Now, I did add shares when it was much lower than $282 per share, but typically when you take a company like either Microsoft or Apple or even Coca-Cola sometimes, these companies do not trade as low as most people will apply their margin of safety due to the fact they typically trade at premiums since they're such strong cash flowing companies. But as for me, anytime this company takes a dive, this is one of the strongest companies in the world, so I do always look to continue to add shares. Now, obviously, like I mentioned earlier, they do have a lower starting dividend yield, so if you're looking to retire off of dividend income in the near future, maybe this isn't the best investment for you, but if you have time and you want to see dividend growth, then this is one of the best investment options out there. The next stock that we're going to be looking at is Lowe's, stock ticker LOW, currently trading at $199 per share. The company was as high as $263 per share earlier this year, but we can see year to date they are down 22%. Now, jumping into our stock valuation spreadsheet, we'll come up here and plug in their stock ticker and hit enter. And if we come over here and look at the dividend data, we can see they currently have a dividend payout of $4.20 per share, dividend yield of right at 2.11%, and a payout ratio right at 24%. So this is another really safe dividend paying company. Something I do want to pay out is if we go ahead and jump over to our dividend discount model and zoom in just a little bit, we can see over the past few years, they have had a major commitment to increasing the amount they pay in dividends. We can see about 4 years ago is about 0.41 cents per share, all the way up to 0.8 cents per share quarterly. Look at the year-over-year dividend growth, 17%, 14.6%, 9%, and then a huge jump in their dividend payouts recently at 33.33%. So their management is obviously focused on increasing the amount they pay out in dividends to help out their shareholders. I'm applying a growth rate of 8% moving forward and a discount rate of 9%, so we get a dividend discount model price per share of $345 per share, much higher than the current trading price of right at $200 per share. Now, some of these other valuations do provide slightly lower valuations, as we can see multiples at 250, discounted cash flow, another pretty strong one at 261, which is analyst price targets, and Graham's valuation right at 263. But if we jump over to our valuation output, we can see average all 4 of these together, we come to an intrinsic value of $279 per share. If we apply our margin of safety of 30%, we can see our acceptable buy price is $195 per share, so very close to that current price. Again, if you have a long investing time horizon, you're going to see really nice dividend growth from this company. Now, one potential risk with this company is the current real estate market. Obviously, with a booming real estate market, Lowe's is going to perform very well. If we were to see a huge decline, that could be a potential risk in this company, but I think long term, this does align with my investment goals. But let's go ahead and move on to our next company. The next stock that I have been adding shares of to my dividend portfolio is Target. We can see over the past year, down a massive 36.5%. We can see a huge decline right here back in May, and this was due to a very poor earnings report. Year to date, we can see they are down almost 30%, but let's go ahead and jump into our stock valuation spreadsheet. We'll plug in the stock ticker and hit enter. And again, let's come over here and look at this dividend data. We can say They're paying out $4.32 per share, giving it a dividend yield of 2.6%, which is a bit higher than it's typically been for Target in the past. Payout ratio of under 30% once again, so that is another good sign. Now, moving averages, we can see over the past 20 and 50 days, this company has started to increase its share price, as we can see right here. 200-day moving average still down pretty large due to the bad earnings report we can see right here. But let's go ahead and jump into our valuations and see if this lower decline in the share price is fair. If we look at Graham's valuation over here, let's go ahead and zoom in, and using this formula here and plugging in the variables, we can see we come to an intrinsic value of right at $278 per share once again. Jump over to our discounted cash flow model. We can see for the future free cash flows, I am projecting a growth rate of 12%, also to the terminal value as well. Added the sum of those future free cash flows together, added the cash and cash equivalents, and subtracted the total debt to find the equity value, divided by the number of shares outstanding to come to a discounted price of $257 a share. Again, pretty close to Graham's valuation. Now, jumping over to the multiples valuation here, we can see taking companies that are similar to Target like Walmart, Dollar General, and Kroger, taking their average price to earnings multiple and applying it to Target, we get an intrinsic value of $261 per share. Now, looking at the dividend discount model, again, we can see not quite as much dividend growth over the past few years, but there was a huge jump over the past year at 32.35%. So that really is a really phenomenal sign. So despite the more poor earnings report, we can see management is still very committed to increasing the amount they pay out in dividends. And when we look at that payout ratio, we can see we have nothing to worry about as far as the safety of the dividend. Now, I'm applying a growth rate projection of 6.5% for the dividends moving forward and a discount rate of 9%. So we do get a dividend discount model price of just $153 per share, which is lower than the current price. But when you take that in comparison to the other valuation models, which really do focus on, things like free cash flow and earnings per share, we do see really high valuations. Average all four of these together, we come to an intrinsic value of $237. After applying our 30% margin of safety, we can see it's right at our acceptable buy price of $166 per share. So I don't think that the huge decline in the share price quite makes sense for Target, and that's one of the reasons that I have been buying. Also because of the phenomenal dividend growth we will be seeing in the future. Now, the last company that we are going to be looking at is Starbucks, stock ticker SBUX, currently trading at $85 per share. We can see actually over the past month, they've had a pretty nice rebound. They're up 10.32%. They were trading as low as around $70 per share earlier this year, but year to date, they are still down 26.53%. But let's go ahead and jump over to the valuation spreadsheet and plug in their stock ticker. We'll hit enter and all of this data will load in. Currently looking at a 250-day chart, so you can see a huge decline, and then here's the run-up over the past month. Come over here and look at the dividend data, $1.96 per share, dividend yield of 2.3%. Now, this company actually does have a little bit of a higher payout ratio at 53.7%. That's a little bit higher than I typically want to see it, but I don't think it's necessarily a red flag. Now, over the past year, down 27%, 2 years up 13%. Analysts currently have a target price of $94 per share, and they were trading as high as $120 per share over the past 52 weeks. Let's go ahead and look at Graham's valuation. And we can see once we've plugged in all the variables to this valuation model, we come to an intrinsic value of $72 per share. Now, that's actually a bit lower than the current trading price, so that's not something we typically want to see. But let's go ahead and look at our other valuations. Discounted cash flow model, we can see I'm projecting a growth rate of about 11.5% moving forward to the future free cash flows. After adding the cash and taking out the total debt, we get our equity value divided by the number of shares outstanding, and we come to a discounted cash flow price per share of $105. Now, let's go ahead and look at our multiples valuation here. And you can see for the multiples valuation, we're taking market comparables like McDonald's, Yum Brands, and Domino's Pizzas. Not all exactly the same structure as Starbucks, but relatively similar, and the market's going to value them similar. So when we take their stock price and divide by the earnings per share, we can see we get the price to earnings multiple, and we do get fairly high price to earnings multiple from these companies. Average price to earnings of 28.61. Multiply that by Starbucks' earnings per share, and we can see if the market were to value Starbucks the way it's valuing the comparables, their intrinsic value would be $107 per share. Now, let's go ahead and look at our last valuation, which is our dividend discount model. And again, we can see really nice year-over-year growth from this company, which is in line with all the other companies, and it's exactly why I have been investing in these companies. We can see 20% growth right here, almost 14%, almost 10%, and then almost 9%. So the average growth rate of those years is 13.13. Again, really phenomenal growth rate. You have to put it in perspective too. Imagine, when was the last time you got a 13% pay raise at your job every single year. When you take it into that kind of light, you can see just how powerful dividend investing can be. So moving forward, I was projecting a growth rate of 6.5%, a little bit lower simply because of the higher payout ratio, but after applying a discount rate of 8.5%, we come to a dividend discount model price per share of $104. So when we jump over to our output tab, we can see all four of our valuations. Average them together, we can see $97 per share fair value. Compared to the current price, we can see of $85 per share. If you apply a margin of safety, our acceptable buy price is about $77 per share. So while that is a little bit lower than the current trading price, keep in mind just a month or two ago, this company was trading as low as $70 per share. So there are opportunities to buy in at phenomenal prices, just like I did. So there you have it. Those are 5 stocks that I've been buying during the recent market downturn. While many of these companies don't have exceptionally high dividend yields, their commitment to dividend growth makes them an attractive investment for those looking to make their portfolio a compounding machine that will allow them to live off of dividends in the future. If you'd like to be able to download my stock valuation spreadsheet or any of my investment trackers, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching the video, and please don't forget to like and subscribe to the channel.